Every core banking system ever installed shares the same basic characteristics. It doesn't get better with experience, until now. Hi everyone, welcome back to Next Move Banking. I'm Virginia Heyburn, Principal Strategist with Engage FI. Existing core systems can process another 1 million transactions. They can open another 100,000 accounts, survive another decade in production, no question about it. And unless somebody changes it, it behaves almost exactly the way it did the day it was installed. For 40 plus years, that was fine, because every bank was operating under roughly the same constraints. Nobody's technology was really learning. All of that is about to change. The race was always between increasingly sophisticated systems of record and, of course, the innovation that surrounded the core, digital experience being the most notable. Most of what we called transformation during those decades was really renovation of the core to support new capabilities that surrounded the core. Last week, I put 5 core systems predictions on the record. Today, I want to start building the case for 2 of them. The competitive advantage is moving above the core, and that AI is beginning to weaken some of the forces that kept this market frozen for decades. The interesting part is that neither change started with banks. They're emerging from inside the technology market itself, and right now I see 4 forces pushing the market in the same direction. Force 1, AI is attacking the most expensive part of modernization. The single greatest reason this industry froze in place has always been the cost and risk of change. Conversions that could take years, modernization projects that were very expensive, operational risks that could keep leadership teams awake at night. For years, the technical effort required to understand, to migrate, and to modernize legacy environments was part of the moat. Not the entire moat, but a meaningful part of it. Now watch what's happened. From one direction, a generation of cloud-native cores, Thought Machine, Mambu, and others, they've spent the last decade proving that a bank's ledger can be API first, it can be event-driven, and continuously updated rather than dependent on overnight batch processing. Now, from the other direction, AI is beginning to reduce the effort required to understand and transform these legacy environments. One example really caught my attention. This year, 2026, Fiserv deployed an autonomous AI software engineer through Cognition against its own modernization backlog. Now, think about that for a second. For years, the assumption was that disruption would come from challengers attacking incumbents. But what we're actually seeing is incumbents using AI to attack the economics that protected the incumbent model in the first place. That's a totally different story. Now, AI does not eliminate conversion risk. It will not. It doesn't eliminate governance requirements. That's not going to change. It doesn't eliminate operational complexity either. Those are always going to be there. But if it meaningfully reduces the technical burden of modernization, then the economics that made a frozen core tolerable begin to change, for challengers and incumbents alike. Force 2, the incumbents are all moving in the same direction. The second force is the providers themselves. Because if you want to know where a market is going, don't just listen to what companies say, watch what they're building. Look across the industry. I mentioned Fiserv. They've made an aggressive push toward modernization from Agent OS to its work with Cognition. Jack Henry, they're investing in a cloud-native platform strategy and progressive modernization. It's been winning deals on that architecture, including in 2026, the largest new core signing in its history. FIS, after the WorldPay separation, they've renewed their focus on banking technology as well. Lots of investment happening. Meanwhile, there are providers like Temenos, Thought Machine, Mambu, others. They continue to push composable API-first architectures. They're different strategies. They are coming at this market change from different starting points. They have different customer bases. But amid all of that difference, they're all moving in roughly the same direction. And when competitors across an industry start converging on the same future at the same time, we have to pay attention, because that's usually a sign that the economics underneath the market are shifting. The people closest to the revenue are going to see that first. Force 3, the conversation moved into public view. The third force is regulatory attention. And before we get too excited about that, let me be clear. I don't think the regulators are coming to save anybody. That's not my point. My point is that the concerns that community institutions have discussed privately for years now, are being discussed publicly. Finally, the OCC's review of core service providers brought some familiar issues into the open, things that we have been talking about for eons: vendor concentration, conversion difficulty, who has negotiating leverage, operational dependency. Those conversations used to happen quietly behind closed doors, certainly not in the open, in the collective industry we voice. And now these conversations are happening in public, and that's where they belong. Here's why that actually matters to you concretely. When a regulator puts the words "very uneven negotiating relationship" on the public record, that becomes leverage that you can carry into your next contract. You're no longer the only one in the room who thinks the terms are one-sided. The record now says so. Now, that doesn't solve the problem, but it moves a little bit of power back to your side of the table, and that power is worth using. Force 4, the world around the core is speeding up. Everybody wants to jump straight to stable coins and tokenized deposits, and they are interesting, but I think they're actually evidence of a larger trend, and I want to zoom out and look at that trend. It's acceleration. Payments move faster, settlement moves faster, customer expectations move faster. Money itself is becoming more programmable. Tokenized deposits, stable coins, real-time payments, whether those developments take 3 years or 10 years to fully reshape the landscape almost misses the point. The direction is what matters, and the direction is clear. The environment around the institution is speeding up. Eventually, that creates pressure on the systems underneath it. We know that that's been building for a long time, and now suddenly in this market environment, frankly, they are intolerable. You don't have to believe every prediction about tokenized money to see that. You just have to recognize where the world is heading, and it's getting faster. Now, what does this mean for you? You might be thinking this really sounds like a big bank story. It isn't. In some ways, it matters more for community institutions, because community institutions have historically had fewer options, less negotiating leverage, higher relative switching costs, and a greater dependence on a smaller number of providers. Just not a lot of options. And this is the part I think gets lost in a lot of the discussion around the future of core. The same AI that's reducing modernization costs for the largest institutions is reducing them for everybody else too. Capabilities that once required megabank budgets are becoming accessible in ways they simply weren't a few years ago. We have to keep in mind that a lot of this core renewal, this modular core systems replacement, this innovation that's happened in the core is not entirely new. Large banks have been doing this for a number of years, and they have seen some advantages because of it. Now, those advantages are accessible to community financial institutions. And if I were sitting in your chair, I wouldn't start by asking whether I needed a new core. Maybe you do. Maybe you can work with your existing core and modernize and innovate from there. I would ask 3 questions. Do we have the contractual rights to use our own data the way we want? Are we creating options or reducing them every time we sign a technology agreement? And then finally, if we wanted to build intelligence on top of our current environment, could we? Because those questions determine how much flexibility you're going to have later, and flexibility is becoming more valuable than most people realize. The opportunity here is not just modernization. It's the first meaningful opening in decades to compete on something other than size. None of these forces matter because they're technological. They matter because they're economic. For decades, standing still was often the rational decision. Costs were high, the risks were real, and the alternatives were not compelling enough. Increasingly, I think that calculation is changing, and once the economics change, behavior usually follows. So the question isn't whether modernization happens, the question is where advantage goes when it does. Disruption is not the same thing as advantage. The fact that the ground is moving doesn't tell you which direction to run. And so that's why we're talking about this next week. That's going to be the entire focus of that episode, because I think the institutions that pull ahead over the next decade won't necessarily have the newest technology. They're going to have something that's so much harder to emulate. They'll learn faster. I'm Virginia Heyburn, and that's your next move.